The opening bell rings at 9:30 a.m. Eastern Time, and the screen instantly explodes into chaos. Candlesticks aggressively whip up and down, stop losses are triggered in seconds, and retail traders are left scrambling to make sense of the sudden, massive price swings. Most of those traders fail here because they fall into the single chart trap. They pull up the S&P 500 or the NASDAQ, zoom in on the latest minute candle, and try to trade that index in total isolation, ignoring the rest of the world. Professional traders take a wider view. Instead of staring at the New York tape, they watch market behavior unfolding hours earlier across completely different global time zones. By the time Wall Street officially opens for business, the institutional market direction was already established and broadcast hours ago overseas. Surviving the volatility of the American Open requires stepping back. You need to anticipate the global handoff of liquidity as it moves from Europe into the United States. A common misstep is treating global stock indices as identical monoliths. To see why they react differently to the exact same news, we have to look under the hood at their specific economic DNA. This side-by-side bar chart shows the underlying sector weightings. The DAX 40 is Europe's industrial heartbeat, driven by automotive giants, chemical firms, and manufacturing data. Contrastingly, the U.S. indices, the NASDAQ and S&P 500, are highly concentrated entities, overwhelmingly dominated by tech giants and the Magnificent Seven. Because of these structural differences, a spike in European energy prices might drag the DAX down, while software earnings lift the S&P 500. Analyzing this internal composition explains why a single news event ripples through different markets unevenly. The chronological flow of capital starts early. At 8 a.m. GMT, the London session opens and the DAX 40 begins trading. Its early morning performance serves as the daily testing ground for global risk appetite. This creates a lead-lag relationship. When institutional money flows aggressively into the DAX during the European morning, those same players are effectively telegraphing their sentiment for the U.S. Open hours later. This dual line graph shows that relationship in action. Let's say the DAX hits a major resistance level at 10:30 a.m. GMT and firmly rejects it, dropping sharply. You will consistently see the lower volume S&P 500 futures mirror this exact downward drop shortly after. Watching the European morning provides a leading indicator. It moves you from a blind, reactive posture at the New York Open into a predictive, cross-market framework. Fast forward to 14:30 GMT. The volatile New York session begins. For this environment, professionals deploy the opening range breakout, or ORB strategy. This candlestick chart shows the first step. Draw a strict horizontal channel marking the absolute high and low of the first 30 minutes. The trigger requires patience. You only execute when a 5-minute candle closes definitively outside these boundaries, signaling a momentum shift. Meanwhile, across the Atlantic at 12 GMT, the early momentum in the European session has already faded. The DAX enters a quiet, low-volume midday drift. You don't trade breakouts in a drifting market. Instead, you use a mean reversion strategy, betting that an overextended price will return to its historical average. By applying Bollinger Bands, traders look for moments where the price pushes too far outside the normal range, capturing profits as it corrects back to the middle. Successfully navigating the daily session transitions means deploying the correct tactic for the correct time zone, high-octane breakouts for the U.S. morning, and quiet mean reversion for the European midday. Technical patterns on a chart are useful, but they are constantly subjected to external macroeconomic forces that act as the invisible engine driving index volatility. This interactive scale illustrates the strict inverse relationship between bond yields and tech stocks. Because tech companies rely on future growth, they are highly sensitive to borrowing costs. When the U.S. 10-year Treasury yield rises, the valuation of the tech-heavy NASDAQ is systematically forced down. Similarly, during big tech earnings weeks, the massive weight of companies like Apple or Microsoft causes the indices to ignore standard economic data entirely, moving strictly on corporate guidance. A perfectly drawn technical setup is structurally vulnerable if you aren't constantly cross-referencing it with the prevailing macroeconomic yield data. Even with the right setup and the right macro data, traders face one final hurdle: applying the same uniform, tight stop losses across completely different indices. We measure volatility using average true range, or ATR, which calculates how much an asset's price moves on average. The NASDAQ has a massive 40-point ATR. The S&P 500, by comparison, has a relatively stable 8-point ATR. This bracket comparison visualizes why a tight stop-loss fails on tech stocks. To survive the inherent noise of the NASDAQ without getting unnecessarily stopped out, you must place your stop-loss at 1.5 to 2 times the ATR. Technical indicators alone won't protect you from a volatile open. True long-term consistency comes from looking past isolated charts and understanding the interconnected chronological flow of global capital. Aligning your trades with institutional direction provides the predictive clarity that single market analysis lacks. Download the FXNX correlation cheat sheet, utilize the FXNX volatility calculator to size your next trade, and open your NX1 account today.